Welcome back to Fast Market here on Schwab Network. Shares of Amazon are slightly lower after a setback for its satellite internet ambitions. Yesterday, Blue Origin New Glenn rocket exploded during a test in Florida. Amazon had planned to use New Glenn as soon as next week to deploy 4 dozen satellites per mission in a bid to accelerate its build-out to compete with Starlink. The timing is critical, with Amazon seeking an FCC extension as it races to meet a July 30th deadline to have roughly half of its planned satellite network in operation. While shares of Amazon are lagging today, that stock is up 3% this month. All right, time now for the tug of war on Amazon. For that, let's welcome back in our co-hosts Tom White and Kevin Green. Guys, it is bull versus bear time. Before we get to your example trades, we've got to get each of your thoughts on Amazon. KG, I'll start with you. Your take.
Yeah, I mean, the Blue Origin situation, it's unfortunate, but at the end of the day, there is a perceived risk when it comes to space exploration. So you're going to see an initial reaction to the downside, but over time, the market's going to shrug that off because Amazon is really the bread and butter of it right now is AWS as well as its retail business. And those are both still relatively strong here. So it's an unfortunate situation, but this administration, I do have to give them a lot of credit. They have been really flexible when it comes to trying to expedite a lot of these space exploration companies like a SpaceX, getting those approvals so they can launch satellites into orbit a lot quicker than what we've seen in the past. I'm sure Amazon is going to see, or Blue Origin is going to see a little bit of a setback here, but maybe not one that's going to take them years in order for them to recover. Right? And I think there's probably some optimism there, and it's a small slice of the overall vision of this company over the next 2 to 3 years.
Okay, great points there. Tom, your thoughts?
You take a look at Amazon, just the different silos that they have for revenue generation. I mean, if you look at the chip side of their business, they talked about that 40% growth quarter over quarter last earnings at the end of April. Then you throw in AWS. That growth was up over 28%, and it's supposed to accelerate to over 30% growth in the coming quarters. So, yeah, we've seen that reacceleration over the last few quarters in AWS. You throw in the fact that the consumer's still out there spending, despite the fact that oil prices are higher and confidence levels and sentiment numbers are down from the consumer. And then you throw in advertising. That was up to $70 billion in the full fiscal year. That was growth from $50 billion from the previous quarter. So you start looking at the areas where they continue to expand. And Andy Jassy, I think, as a leader, has done a great job in, controlling all these different segments within their business and still showing solid and outsized growth in all of them as they move forward. CapEx spend, yeah, that's been a concern from some investors, but the stock's only a couple percent off its all-time highs. It just feels like, the different segments that make up Amazon at this point starting to level the playing field where they're not relying on the retail side or they're not relying just on AWS growth at this point. They've got a bunch of different levers to pull here, and that's why the stock has done so well.
All right, let's get into the example trades. KG, let's start out with yours. What's your approach today?
Well, if you're kind of looking at it from a chart standpoint, we do have a lower high taking place right now. We've been leveraging the 20-day moving average as an area of support, but we are also making lower highs on the RSI. And for whatever reason, if you look at the seasonality over the last 5 years, starting in June, we usually do see a pullback within this name. Now, it doesn't seem like that's a broad market situation. It seems like it's just company specific. Yes, you have some headline issues as well. So I'm actually looking at for an example trade, a pullback and trying to retest that 20-day moving average in blue here. So looking at the June monthly expiration, June 18th, 265 puts, going long outright on this at $4.85. So the max loss on this trade is $485. Max profit is $26,015. That's if the stock goes to zero. We have bigger problems if Amazon's trading at zero by the time of expiration here. And break-even point is going to be $260.15. This is a structured trade where you want to be able to identify your take profit level as well as your stop loss level. And because you do need to move here within the next 18 days or so. So you will have time value erosion going against you for this trade. But any type of sharp pullback to that 20-day or even a break below that, this trade may be able to be profitable. So I'm curious to see what Tom thinks about this trade setup, given the technicals as well as maybe some of the near-term risk for this name.
Yeah, we've seen, with the stock at these elevated levels just below record highs, that implied volatility levels are down. So Kevin's example trade here to the bearish side may make sense if you think the stock's going to fall over the next basically 3 weeks. You got 20 days in this. Let's break it down. June 18th, monthly options. You buy the 265 put. You pay roughly about a 485 debit. Probably pay about 420 right now because the stock has moved a little bit higher today as equities reach session highs here. But you pay that 485 debit. There's your risk, $485 per spread. As Kevin mentioned, the break even just above the $260 level. That break even is about 4.5% below the current share price. So as KG mentioned, you need a move to the downside for this thing to start to expand. But if you do get a move to the downside, what historically happens is implied volatility levels start to go up also, and that may expand the price of this straight put purchase here for downside exposure on this one. Now, I mentioned you need about a 4.5% move to get below that break even. The probabilities are against a trade like this, but at the same time, it's still risk defined. You know exactly what your downside is, and it gives you that flexibility as far as trade management goes, because you don't have to wait the full 20 days to potentially profit or get out of this trade. If the market's open and this stock maybe goes down to 260 and this thing expands to $6 or $7 or $8, it gives you that opportunity that maybe, hey, I can close a portion or all of it if the market's open. So it does have that flexibility as far as trade management. Buying a straight put with lower implied volatility also lowers the risk of this type of trade, because extrinsic option premium contracts when you've got implied volatility levels where they are, which is about 24% on an IV percentile level. So in the bottom 1/4 of what we've seen implied volatility over the last 52 weeks in Amazon. So there's Kevin's setup to the downside. I'm going to flip the script here. I went a little bit more bullish, but instead of just buying a straight call, which would be a bullish type of strategy, I looked at offsetting some of the costs. So I looked at a bullish call vertical here, went out to that July cycle. So also giving myself some duration on this one. It means I'm going to have to pay more for this type of vertical, but it also gives me more time in it, and that's why it costs more. But going out to the July monthly options, buying the 270 strike call in the money by a couple bucks here. It's got that higher delta. That's the bullish portion of this vertical. And then against it, sell the 295 strike call. So a bullish $25 wide call vertical. You're paying roughly about a $9 debit. You might have to pay a little bit more, maybe $9.20, because the stock has moved a little bit higher. But the debit you pay is your risk on this one also. $900 per spread on this one, but that can expand to $2,500 if it goes up to above the 295 level. Now, why did I pick the 295 strike? Well, you go out to the July monthly options that expire in 49 days. You got a plus or minus $26, $27 move that the option market's pricing in. So that lines up approximately near that 295 strike. So, Kevin, bullish $25 wide call vertical. I'm offsetting some of my costs on this directional vertical, but the same effect goes in. You know, you pay a little bit less when implied volatility levels are lower, but you definitely need to move to the upside on this one to that break even at 279.
And that's pretty much where the highs were back in, let's say, early May here, Tom. So you're leveraging that short call position to offset the long call that you're buying. But you also have a decent risk-reward ratio. It's a traditional risk-reward ratio. You try to get above, that 2-to-1 if you could. But you do need a little bit of a move, but you also have time. It will not erode as quickly. And you kind of, once again, kind of boxed in some of that theta decay by selling the upside call. But you do need a move. But the primary trend has been to the upside, at least for now. If you do continue to see a break above those highs, and you still have a lot of this enthusiasm when it comes to the technology trade just in general, Amazon could be a beneficiary of that. And this trade also gives you some flexibility to manage the trade in the event that it does go against you, right? If it goes to the downside, it won't be as aggressive as if you were just going